Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Tom Idzarek, Head of Economic Research for Morningstar Investment Management. Hi Tom.
Hi.
So you just did a quick pop quiz among the attendees of the Morningstar Investment Conference where we are in Amsterdam, and you found that time and time again, investors voted for the shiny stock, the stock that everybody wanted.
Right, that's absolutely right. I opened up my talk with 5 what I thought would be easy questions. Do you prefer, a speculative investment or, a safe investment? Do you want something that has lots of capacity versus low capacity? A powerful brand, low brand, high reputation, low reputation, etc. And time again, as you point out, people really want what is the very best characteristic. And of course, as it turns out, people want that characteristic so much that, they swamp into those stocks, bid up the price, and often those are the ones that end up performing relatively poorly in the short term.
Because of course we can't all buy the same stock at the same price, can we?
No, we can't. And again, it's that over-popularity. We tend to love great companies so much. You could almost say we're over-loving them, right? And then we dislike, let's say, bad companies, but we overly dislike them. And eventually there's a return to fundamentals, and there can be a premium that's actually harvested by systematically investing in, let's say, unpopular characteristics, and eventually some things that are unpopular will become popular, and those things that are very popular will inevitably have a reduction in their popularity.
Because Investing 101 says that risk equals return. So the higher risk you take on with a stock, the higher returns you take on. But you think this concept is actually flawed, and this popularity concept is a better one, it applies in more circumstances.
Right. Well, so that traditional view of more risk equals more return, it works at the asset class level often. So, bonds outperform, let's say T-bills, and/or stocks outperform bonds. And that relationship seems to hold, throughout different marketplaces in different countries. But once you dive into a particular asset class, such as equities, and you have, let's say, similar overall risk characteristics, it's these other characteristics that begin to matter more than risk. And again, what we see is that traditional paradigm of more risk equals more return begins to break down. And we need another theory, a new theory, and in our case, the theory of popularity, that seems to explain all of the, let's say, recognized risk premia that are out there, as well as the various anomalies.
And one of the risk premia, rather the popularity premia that you mentioned, is a company having a strong brand, a strong competitive advantage over their peers. And we at Morningstar call that an economic moat, which we've learned can lead to outperformance over the long term. Now, these two theories to the layperson sound like they're mutually exclusive, but you say actually they can work together.
They can, and so again, I guess to me, moat, having a wide moat or a sustainable competitive advantage is something that we think makes a wonderful company. Now, I think what we would also stress is that doesn't necessarily make them a great investment, especially over the short term. Another factor that is critical, and one where we do a lot of work, is coming up with a fundamental valuation associated with a given firm. And so the ideal company would be one that has a very wide moat or very large sustainable advantage, but that you could get at a very attractive valuation.
Because it's about great companies at great prices.
It is that, exactly.
Tom, thank you very much.
Okay, thanks.
This is Emma Wall from Morningstar. Thank you for watching.